Afternoon, everyone. This is Kimberly Byrum with Zonda Advisory, and I'm pleased to be able to present our first quarter multifamily update to our clients and good friends. I want to give a little bit of a background on Zonda's multifamily advisory team. We have 11 professionals based in Dallas. We also have team members in Austin, San Antonio, the Mountain West, and Orange County. On average, our consultants have 15 years of industry experience. We work nationally. We produce about 250 studies a year, and a lot of what we do is on the pre-development consulting side. We're very early into the process. We also have experience in Hawaii, which really, I think, adds a perspective on a lot of the different things that we do throughout the country. We produce on average 25 customized market surveys per month. We don't do any off-the-shelf reporting. I know we get a lot of phone calls asking us, hey, can you just pull this or that? But everything that we do is very custom for our clients based on the projects that they're planning. We also have experience in all high-density products, including horizontal apartments. And we have a very strong background in high-rise development where we've underwritten over 140 buildings since 2014. And if you ever have a need, please contact myself or John Christian, who manages our office at jchristian@zondahome.com. So happy to present to you this afternoon some different components of what's going on in the market currently. I wanted to start with the national context and where we are today. I want to dig deep into the rent surge that began to occur in July of last year, give you our outlook on where we stand on supply and demand fundamentals, and then I want to go a little bit into operating expenses. This is actually data that we presented at our multifamily conference in Vail, and if you haven't had a chance to go to that and you have spring break around March, I highly recommend that you sign up. It's a great time and a lot of really detailed information and very C-level attendance. So it's a great opportunity to get up close and personal with leaders in the multifamily housing industry. So jumping right in, where do we stand and where do our residents stand in terms of what's going on in the national economy? Well, probably first and foremost is the volatility, and specifically as it relates to the stock market. We've been seeing volatility really throughout the pandemic, but I pulled some data on what's called the Fear Index, which is a real-time market index that measures the market's expectations of volatility in the coming 30 days. And it was very interesting because if you look in 2020, the index closed above 30, and 30 means that we're expecting more volatility than normal. So the index closed above 30 72 days in the year 2020 during the height of the pandemic. In 2021, it was only 6 days that it closed above 30. And then just to put a perspective on where we stand today, so through the middle of May, we have closed above 30, 24 days, and many of those were, I want to say, consecutively over the last 5 to 7. So we're really seeing a lot of volatility in the stock market, and our residents are feeling that as well. Obviously, inflation is top of everyone's mind. The Consumer Price Index for April indicated that all items were up year over year, 8.3%, with food being up 9.4%, and of course, energy being up 30%. So overall, when you exclude those two large measurements, we're still up 6.2%. So that's a real big issue on the minds of our residents. However, we do have rising wages, which is good news if you're an employee, but bad news if you're an employer. Overall, the Conference Board surveyed managers in November of 2021 and asked them what their budget was for wage increases in 2022, and they said about 3.9%. And that was primarily driven by the fact that going out in the market and trying to hire new people, the salaries are so much higher that they needed to adjust current employees up to keep everybody equitable. The Employment Cost Index as of March of this year actually indicates that compensation's gone up about 4.8%, with most of that being at the service industry's level, but still a little bit more than what managers, I think, had anticipated or had budgeted for the new year. And then overall, increasing interest rates. We've obviously a big talk. If you listen to Allie's COVID webinars, and Tim is weighing in on those, you'll hear a lot of talk about interest rates. Allie most recently quoted 5.25 to 5.75 in terms of rates, up from the high threes. And then also another big news item out there is corporate landlords pricing home buyers out of the markets, and that's overall in just that rent to build for rent market. And lastly, the great return to the office has now been muddled a little even further by the inflation, the cost of gas, the cost of food that we're worried about as we're kind of heading into the summer. If you look at the Conference Board consumer confidence measurement, you will see that the expectation is in the orange and the present situation is in the blue. We are at we're at a high, not an all-time high. We were very high prior to the pandemic. You can see that we've jumped back up to normal levels, very nice levels of confidence, but the expectations for the future are a little bit less positive. You can see generally that the survey indicated that consumers feel good about business conditions, but they are starting to notice, or they anticipate, that jobs are getting harder to find, and that just a sentiment that jobs are plentiful has declined by 3%. So just overall a little bit of mixed feeling about where we're headed certainly in the summer months and going into the fall. So where do we stand on overall occupancy in the multifamily space? Well, I use the term all-time high a lot, and I started that really back when the pandemic hit, because in 2020, first quarter, we were at a pretty high occupancy level, so I knew if we did drop, we were dropping down to more normalized levels rather than below into some potential problems. So since that time, we have continued to increase our occupancy with a little bit of a slowdown in the middle of the pandemic, but we're now hitting 97.6% as of the first quarter of 2020. A couple of things I want to point out too on this chart is that the gray line is for the fourth quarter, and you can definitely see that the second and third quarters in this historical time period are higher. That is, seasonally, those are our biggest leasing periods, are the second and the third quarters of the year. And we're facing a 97.6% occupancy going into this second and third quarter leasing season. And importantly, we're at an all-time low of vacant units available because we've gobbled up vacant units as well as new construction. We have a limited pipeline that we're looking at for this year, and then we also have very high renewal rates that I'll show you. So this chart illustrates renewal rates going back to 2019, so pre-pandemic, and it's a very interesting, I think it really overlays what's going on in the market well. And I've also put on here what the homeownership rate is during these specific time periods, because one of the things that we're always concerned about is how we may be losing residents to home ownership. And you can see just over this time period, home ownership has changed very minimally. If you look in 2019, the rate was 65.1%. We went up, or dropped down in renewals, but went up in home ownership to 65.8, and now we're back to 65.5. So really not a lot of change there. But if you look at the renewal rates, you will definitely see at the peak of the pandemics, during the lockdowns, when businesses were not open, movement was very rare. We were at an all-time high on renewals at 57.4%. That did come down as the reopenings began. Of course, kind of that inflection point there is when we started to see inflation based on supply chain issues. And then as the first, second, and third quarter of 2021 occurred, you start to see that renewal rate creep back up. And so if you look at the people that renewed in second quarter of 20 and you compare that to second quarter of 21, we lost 2 percentage points, call it, of people that moved on from their current residence. But for the most part, most of those people still stayed put. Starting at the end of the second quarter and into the third quarter, we began to see the rent surge that I'm going to describe and talk about in detail. And we saw that renewal rate tick back up to 57%. And then actually we've now hit another all-time high of 58.3 as of the first quarter of 22. So the rent surge. I wanted to drill down into this because there's a lot of talk about what's happened in these markets, and I wanted to give you a perspective on, really month by month what we've seen. Overall, and this is an example, I've included Orlando Class A apartments here, but this shape that you see here, starting very high and kind of bumping down lower in the fourth quarter and then coming back up, is pretty similar in just about any market that you would analyze. So the rent surge really began end of July and into August of 2021. You saw the strongest growth in Tampa and Phoenix. Those were very large initial spikes, and that's a month-over-month rent increase, and asking rents of 3.4%. Las Vegas was right behind that at 3.3%, and then Orlando, which you see in the picture, was at 2.9%. And so this was an actual, just out of nowhere, we started to see these asking rents begin to really, really improve. As a baseline, if you have a budget of a 3% rent increase for a year, that would, and you were spreading that over 12 months, your baseline would be about 0.33% per month. So that's a pretty large jump compared to that baseline of 0.33%. You can see that as we went into the fourth quarter, there was some seasonality that impacted these rent numbers, and in some of the markets, you even saw that rent change be zero or maybe a little negative, but really just kind of price discovery, in my opinion. So it went down and then started ticking back up in January, February, March. So going into the summer months, really all of our markets that we track and are active in are way above that 0.33 benchmark, with Phoenix and Jacksonville maybe not as positive as the others, but still 2 times that 0.33%. Orlando and Charlotte are still at a very high level of these monthly rent increases, and then we're also seeing those same trends in Austin and Raleigh. Occupancy, which is on the opposite axis, is, quote, falling, and I have that in apostrophes because it's to keep in mind that this is only 1 percentage point if you look at the axis going from 97.5 to 96.5. So that occupancy in March went from 97.3 down to 96.9. So really just some move-ins and move-outs, but that's probably more of a timing issue. So not really seeing any drops in the occupancy as of yet. So these 2 charts illustrate how the markets have performed during this rent surge and by asset class. So the chart on the left is Class A rent growth, July through April, and this is a cumulative number, and the chart on the right is the Class B rent growth. You can see that the majority of the markets have experienced over 10% rent growth in asking rent over that time period. Orlando being on the high end at almost getting close to 18%, and that is, again, that monthly, that's a 9-month period. On the flip side, we aren't seeing, and these are under 8%, but really Sacramento is right around 4%, which again is strong because we would typically budget between 2 and 3% increase, so way over budget already. Seattle is at 6, Denver is a little almost to 8, and Houston's a little bit of a late bloomer, as they typically are. Obviously, they will continue to benefit from the high oil prices that we are seeing, and will start to bump back up and play catch up with some of the other Texas markets. When you compare the Class A to the Class B, Anaheim's Class A outperformed their Class B by the widest margin, but technically you usually see the Class A and the Class B performing right in lockstep. On the Class B side, Seattle and Nashville outperformed the Class A in the market by a wide margin. So what are the Reits saying? Overall guidance, at least beginning for the first quarter, is very positive. A lot of optimism in terms of the rent numbers and the pricing power. You can see that. UDR quotes, pricing power is robust across our regions. The Avalon Bay first quarter report had some really interesting statistics talking about the positives that are going on in the multifamily in their markets, talking specifically about people moving into their markets from over 150 miles away, the de-densification of units, so their average household size is decreasing, which means that people are moving out and moving in on their own. Obviously, the median household incomes that we talked about earlier with the wages improving are up. And then, of course, the cost of home ownership, and I'm going to talk a little bit more about that, is moving in the favor of the rental market at this time. So one of the questions that one of my favorite clients always poses to me after we have a big, long discussion about the markets is, well, how can a renter sustain these types of increases, and how does that impact affordability? So this chart represents the Class A rent as a percent of area median income, and that would be, I'm taking the two, if the metro areas are comprised of 7 or 8 counties, I'm taking the 2 largest county to calculate the area median. And so overall, when you look at the markets that we're the most active in, excluding the Bay Area and New York, there are really only 4 that fall outside that 80 to 120 threshold, and that's the HUD threshold for a typical market rate apartment community. So on the low end, you see the Texas markets, in the middle, the Phoenix, Charlotte, Raleighs, and then on the top end, Florida. And Florida's median incomes are somewhat impacted by the older populations that are there. And so they do have lower median incomes in some of the major counties. And so you see that Tampa actually falls outside, just slightly outside of that AMI. I think it's about 121%, and same as Nashville. And, of course, Los Angeles and Riverside are notoriously markets that are not as affordable. So we've really kind of beat the dead horse on where the COVID migrants went, but I wanted to illustrate where the markets that had a very large increase in demand compared to their typical demand during the pandemic. And while there's a lot of markets that fall below 40%, these are the ones that were the most standout in terms of their historical absorption compared to their COVID absorption. And so Fort Worth actually tops these markets in terms of percent increase in absorption. You see that they went from about 3,000 units absorbed to about 8,000 units absorbed on average per year. Sacramento is at 114%. Jacksonville was at 4,200 compared to their, again, smaller numbers. Houston is a big market, has big absolute numbers at 74%, and then Tampa and Orlando also. Obviously, in overlaying the AMI, you can see that many of these markets are the affordable markets, but then, again, the Jacksonville numbers are a little skewed. But when you overlay potentially someone moving from the Bay Area to Sacramento, even if they had a salary reduction, they'd be well within the affordability ratios, and in fact below the 80% coming into Jacksonville from the Northeast as well. So while they look, just as a measurement, maybe a little on the unaffordable side, certainly someone coming in from another market would have a different perspective. So taking that all the way down to just the decisions that renters may be making right now. We talked early on about what's on their minds with the volatility and the pay increases and, what's going on in the stock market and the mortgage rates. And so what I've done here is I've taken just a typical Class A renter in Dallas. I've calculated their take-home pay. I've deducted out federal income taxes. There's no state income tax in Texas. And I'm matching them to the area median. And just by chance, I compared that number to the lease demographic data that RealPage provides, and it was right spot on. So that was a comfortable calculation. So assuming that a typical Class A renter in Dallas takes home $5,800 a month, let's assume that they received a 5.5% salary adjustment at the beginning of the year. So that would equal about $320 more per month that they are receiving in their paychecks. Maybe they sustained a rent increase of $176. Hopefully they were good negotiators and got that down a little bit. But overall, they still have $145 of take-home pay to cover all of those other rising costs. So overall, the Class A renter is still pretty much in the green in terms of their income compared to the rent increase. I compared that to if I wanted to go buy a house in Plano. I searched the Zillow listings in Plano and found a pretty decent house for $440,000, assuming a 10% down, comparing that to my $1,800 rent that I may be paying in Dallas. at an interest rate of 5.25, and just throwing that into the Realtor.com rent versus buy calculator, what I found was that buying is cheaper than renting after 9 years. Just to put this in perspective, and we look at this chart all over the country, at a rate of 3.95, that's a 6-year difference. So these mortgage rate increases are really impacting renters, and as Avalon Bay pointed out in their first quarter results, that homeownership, the cost of homeownership is really going to make a difference in the rental markets. Overall, if you did listen to Allie's COVID webinar the other day, she had a really great chart in there that showed what the payments were pre-rate increases to current, and in Dallas it was a 38% increase in monthly mortgage rates. The supply and demand, where do we see that headed? This chart, and so the purple is the demand, and of course your eyes are going to go straight to the 600,000 units that were absorbed in the fourth quarter of 2021, or overall 2021. But I wanted to explain that the purple is demand, the green is supply, and you can see that we aren't always in lockstep. There's always a little bit of either we're overshooting demand or we're overshooting supply just from a delivery standpoint, but we kind of bump around in that 300,000 to 350,000 unit range. During the pandemic, that number doubled. I suspect a lot of that has to do with the renewals and people just staying put, and then just real demand continuing to happen. So we had almost a double cohort of demand that hit the market during that time period. We don't expect to see that continuing forward. And in fact, as the Fed continues to slow the economy down with the rate increases, we are anticipating demand to slow somewhat while supply begins to ramp up, but that is needed because, again, we're sitting at the beginning of this presentation. I showed you that occupancies were at 97.6%. So we do need this building to occur so that we can bring that number back down to a more sustainable number and moderate some of these rent surges that are occurring. So overall, I think that at the end of this building period, by 2024, we might be down in the 96% range again with these types of demand numbers versus supply numbers. So how are the lease-ups doing? This is a really important thing because this is where we sit today. Overall, we're still seeing between 20 and 25 move-ins per month, and that is our general benchmark. You can see here some of these markets just move in slower traditionally. Phoenix usually runs about 18 a month. Some of these higher density markets move in at a slower pace, and that is more related to just in an elevator time frame, moving people in and out. It's just a slower absorption. But overall, if you look at the activity and lease-ups across these metros, the number of units in lease-up are down approximately 20% this year. And so we're just not seeing the amount of new units hitting the market. And we know that. We've been talking about that. We do think there will be some relief in that area in the coming years. But just to put this in perspective, Dallas typically averages about 90 projects in lease-up per year, and we currently have 59. So we definitely are missing out on the pipeline that is typically hitting the market. Another important point here is that even at these unprecedented demand levels, we're not seeing 50 move-ins a month. And a lot of that has to do with just it's more of a timing. Again, like I said, a calendar. You only have so many weekends a month that people want to move on the weekend. Not a lot of people take time off during the week to move. And so you've just got this, unless you've got like a student housing mentality where you're moving in everybody in a 2-week time frame, you just don't see those high levels of absorption sustained over time. You might see them in the early parts of a lease-up when they've done a lot of pre-leasing activity, but generally, as it spreads out over a 12 to 14-month period, you will see that go down in the 20s. So what markets are we concerned about? What markets do we think are in balance? And generally, we do believe that most markets are underbalanced overall. But in taking a look at these markets and saying, assuming that our demand normalizes back to where we were, not the Fort Worth 7,900 units that they've absorbed during the COVID period, where are we at? What's the state of the pipeline with what's under construction and at least over the next 2 years, which we have a very good handle on what's going on during that time. I think it's really probably the most fascinating thing that you'll never hear me say again is that Dallas, at this metric, seems to be undersupplied based on these calculations, and I don't think in my whole career I've ever said that Dallas was undersupplied. But overall, you see Las Vegas, Riverside, and Houston, and again, I mentioned earlier that Houston is a late bloomer and will begin to pick up. Pipelines that are in balance, I kind of have low, mid, and high markets there. So on the low side, you've got Anaheim and Orlando, Denver, and Charlotte, and Raleigh. In the middle period, you've got Seattle, Los Angeles, Tampa, Atlanta, and then on the high side, you have Nashville, Fort Worth, and I've got an asterisk by Fort Worth because, again, I'm assuming they go back to normal, and then Austin and Phoenix. And then on that pipeline full, I do have two markets, again, because there has been some ramp up in Jacksonville because of the demand, and then Sacramento. But Sacramento is a real interesting market because it is in California, and it's much harder to get projects through the process, and so it's probably a little overstating that it's full, but at least based on the metric of where the historical demand is to what's under construction, we might be a little on the full side there. So lastly, just wanted to give you a little bit of a perspective on operating expenses and what we're seeing there. A couple of years ago, we began to survey apartment communities on staffing levels and other income items to really get a handle on how to underwrite operating expenses. And interestingly, during this time period, we've started to have some clients come to us where appraisals are coming in, not missing out on the income side, but missing out too high on the operating expense side. So as you know, there really is no good comp when it comes to operating expenses, but some of the control variables are project size, age of buildings, and building type. So we analyze our own data, we look at third-party data providers, we pull information from CEL and Associates. They have a really good salary survey. And we look at transactional data. RealPage offers it, as does Yardi, and so those are really great information, as well as just looking at the quarterly reports. So overall, of course, payroll and related is our number one expense in multifamily outside of taxes and insurance, and so we spend a lot of time on our people. So looking at how payroll has increased, over what I did is I looked at the change during the pre-pandemic to pandemic, but then I annualized that number. So overall, you're seeing kind of right in line with what we saw in the national numbers, just salaries generally. Obviously, the Midwest has sustained the highest increases in salary, probably to keep people in the Midwest, but they're still on the lower side overall, and that's the same case in the South. The lowest increases have been in the Northeast and the West, and again, as I mentioned, they're pretty spot on with the national data that we're seeing coming from the Bureau of Labor Statistics. Another important point, too, because rents have surged so dramatically, as I've already pointed out, some of these ratios, and the ratios are a real tough thing to consider, went down because of these rent increases. So they've been most aggressively down in the Northeast and the South, but overall, the ratios are down because the incomes are up. So digging into the salary and personnel, this is very fascinating, and I think that what this really puts forth is how important it is to be strategic about your hiring and about your salaries and about the experience level at your properties. But overall, there obviously is a premium to be paid for people with more experience, and that makes sense. But when we took each of the different position categories and looked at them compared to their just the overall increase average, you can see some really pearls of wisdom here. Kind of starting in the middle there, the property manager of a 300 to 450 unit deal on average is getting, they kind of set the average pace for their income increase at average. You can see that their variation, and that's from low to high, is $21,000, which is almost 30% of their salary, which again just means that I'm probably paying more to a person with more experience at this level than they have a lot more bargaining power than someone with less experience. But most importantly, on the upside, on the top part of this chart, you'll see that the maintenance tech, or an entry-level maintenance person, had a 1.2 times increase in their salary compared to the overall average. And so what that tells me is that this guy's pretty easy to pick off, and so we really need to pay them more to keep them to stay overall. And although there's not a lot of big variance in their salary because you're not paying for experience, they're getting promoted up into another position, right? Leasing Manager is another one where you see a big variation, and so they have a lot of negotiating power there. A good leasing manager can get a higher salary, and they are also getting a higher increase compared to the average, as is the regional marketing director. On the flip side, the assistant property manager is kind of the one that I circle. When you listen to a lot of the national property management folks, they will talk about eliminating staff members potentially as we continue to automate a lot of the leasing processes and things. And that seems to be the one position where I think that everybody seems to be targeting an elimination. You can see that gets a lower than average increase in salary and not a big variation in their overall income for experience, because again, that person's probably getting promoted up into property manager. So how are properties staffing? What are staffing ratios like? This data presents surveys that we have done with comparable Class A properties across the United States. And so in the purple is the staffing ratio of the office staff members, and in the green is the ratio, of the maintenance staff members, and that's per number of units. So overall, we've always, as an industry, kind of talked about we have one staffing member for every 100 units. That's just not true, and I don't think it ever has been. Overall, the NAA data suggests that survey is about 1 to 45 units overall, and that is definitely consistent with what we're presenting here, is that 1 to 46 or 1 to 45. So you get a couple of observations here. Obviously, a 350-unit community is where you get your best economies of scale in terms of number of employees, and you do see more variation in the maintenance staff than you do in the office staff. You kind of keep that ratio is pretty constant throughout. It's a little lower on the high-rise side, and that's probably because they contract out more of the services there than they keep on staff. Overall, these ratios are fascinating, and compared to, I know UDR has been on the forefront of trying to improve their operating platform in order to eliminate positions, and overall there's some case studies that they've presented over time, and they've improved their staffing ratio from a low of 1.31 to 1.42. As of their 12/31/21 investor presentation, they were presenting a ratio of 1.44, so kind of right in with what we're seeing here. And then overall, one of the ideas is if you're offsetting payroll by eliminating positions, you may be increasing your administrative costs because you would be investing in more technology and things like that. Maintenance costs. So maintenance costs during the pandemic went down because we shut things down. We didn't allow our community centers to be used, things like that. So we didn't have as many maintenance costs, but then that number sprung back up in 2021. So overall, probably a net of 1% increase. Going forward, we're hearing a lot about supply chain issues and, of course, inflation improving or increasing those costs at that level. We're also hearing a lot about innovations, about smart buildings, predictive failure monitoring, things like that, so that we can get ahead of some of those big costs that might overcome some of these budgets long term. Taxes and insurance. This is the whining part of the session. You can see here that, and these are actually lumped together. There's no way to pull them out because I'd love to see the insurance alone. But overall, the high property tax, high value states, you can see Texas, New York, California actually falls kind of in the middle somewhat here, and then on the low side would be Kansas, Las Vegas, Phoenix, Salt Lake City, Indianapolis, places like that. Interestingly, of course, where the weather-related issues are very much impacted by that. And then in Texas and Florida, the reevaluations every year is an issue. Overall, our numbers suggest that taxes and insurance have increased 32% over the last 2 years. So this is our prediction for where we see expenses in 2022. You can see that in 2019 compared to 2019, 2020, and then coming back out of the pandemic. But overall, we're suggesting, of course, utilities staying about the same, taxes and insurance going up about 15%, payroll going up 5%, maintenance going up 2%, marketing at 3%, and that might be a little high just because if you look at what's going on in the markets and not having a lot of lease-ups to compete against, maybe you can cut back on some of those marketing dollars, and then admin at about 3%, which again, if you're looking at eliminating some of the payroll, I would see an offset a little bit in that technology that you'd be wanting to put back into your G&A there. Overall, the REIT guidance, it was interesting. If you look back at their third and their fourth quarter numbers, they were thinking that number was going to be 3%. They've upped that increase in expenses to the 5 to 6% range. I'm at 5.5 to 6.5% overall. So wrapping up quickly, based on trends today, we think that 2022 is shaping up to be a very strong year for multifamily, certainly on the rent side, and not a lot of pipeline coming down to compete against. Renewal activity in the second quarter will be a great indicator of where we're going and where the market is stable. Rising interest rates are definitely working in our favor as it impacts that rent versus buy calculation for our residents. You have me on record as saying that Dallas is in fact undersupplied with multifamily units, and then overall just looking at operating expenses and being strategic about our salary increases based on what we're seeing in the market in terms of some of our different categories. I want to thank you for joining us and give you just a little commercial about some of our upcoming events. We have a virtual event in May the 24th and the 25th, which is our Prop Tech, talking a lot about technology and innovation in multifamily development. And then we have our MFE conference in Las Vegas in September, and we'd love to have you there. We have a great lineup of speakers, and we'd love to meet you in person.